Smart money concepts, or SMC, is not just a trading strategy, but the entire philosophy about how markets work. Traders present it as a unique and highly accurate forecasting and trading cutting-edge technique that uses a mix of proven methodologies. It involves using new concepts like order blocks, mitigation blocks, and fair value gaps, which makes SMC trading quite challenging to understand if you're a beginner. But don't worry, in today's video I will show you the top 3 indicators that will make it a lot easier for you to understand and use SMC in your trading for maximum profits. Let's begin. By the way, these tools work on all time frames and all markets that have sufficient level of liquidity. Those can be forex, stocks, or crypto. So the indicator on the third place is called the order block finder. Make sure that you select this one by Wagamlo. The purpose of this indicator is to help identify institutional order blocks. Often these order blocks can be observed at the beginning of a strong move, but there is a significant probability that these price levels will be revisited at a later point in time again. A bullish order block is defined as the last down candle before a sequence of up candles. For example, if the market forms 5 consecutive bullish candlesticks after a bearish candlestick, the indicator will print a bullish order block label. On the other hand, a bearish order block is defined as the last up candle before a sequence of down candles. The theory says that big institutional investors are using these candles for their initial entries. So the assumption is that these players are behaving more smart than the general market and tend to buy lower and sell higher than the average, and therefore most probably have a more favorable entry price than the average. By the way, you can adjust the relevant periods to identify order blocks in the input section of the indicator. Okay, now let's understand how we can use this indicator for our trade entries. For the signal to buy, we want to have the indicator spot the bullish order block first, and then wait for the price action to make a pullback into that area. And as soon as the price action crosses and closes above the order block, we can go ahead and place a buy order. The stop loss will be set slightly below the recent swing. And for this strategy, it's recommended to target 1.5 times the risk. We see the price action perfectly bounced off this level of support and hit at a profit target. Okay, let's take a look at the next example. Here we see we had a second pullback and then the price crossed and closed above the order block. If you're scalping on a 5-minute time frame and lower, make sure you leave some room for the stop loss so that you don't get stopped out. Okay, now let's learn the sell positions. First, the indicator must print a new bearish order block label. Second, we're going to be waiting for the price action to retest this level. Third, we open a sell position and place a stop loss slightly above the recent swing. If the price action does not respect the order block, the trade can't be taken. As we can see, we had 7 trade entries within one day and they all turned out to be successful. If you want to minimize the losing streaks, you definitely need to add a volume indicator and the 200 EMA just to know the overall trend direction. Okay traders, now let's move on to the indicator number 2. So in the second place, we've got an indicator called ICT Fair Value Gap. This is a very useful indicator. I created multiple strategies with it and they all turned out to be successful. As we can see, there are quite a lot of them, but the one that you're looking for is this one by Imad L. Okay, so before I show you how to use this indicator properly, let's understand what the fair value gap is. Fair value gaps occur when a price leaves a specific level where there is less trading activity seen and only has a one-directional price movement. It is proven that the price is most likely to reach out to areas where there are fair value gaps and liquidity voids. The liquidity void is a very similar concept to the fair value gap. It usually occurs when the price moves sharply in one direction. This is portrayed by large candles that have little trading activity as price moves in one direction. Eventually, the price will return to close the liquidity void later. And this is exactly the time when we want to enter the market. Fair value gaps and liquidity voids are both indicators of sell-side imbalance and buy-side imbalance in trading. The only difference is how they are represented in a trading chart. As mentioned previously, liquidity voids occur when price moves sharply in one direction, forming long-range candles, whilst a fair value gap is a gap in price. A bullish and the bearish fair value gaps are formed by 3 candlesticks. A bearish fair value gap occurs when the price action moves sharply to the downside. The top of the gap is the low of the previous candlestick, where the bottom of the gap is the high of the next candlestick. On the other hand, a bullish fair value gap is formed when the price action moves sharply to the upside. The bottom of the gap is the high of the previous candlestick, and the top of the gap is the low of the next candlestick. Okay, now let's understand how we can use this indicator in our trading. Let's start with sell positions. First, a bearish fair value gap must occur in a market. Second, the price action needs to close below it and then come back to it. And as soon as the price action leaves the fair value gap, this is when you open a sell position. It's recommended to set the stop loss for the strategy slightly above the fair value gap. As for the take profit, you want to set it at 1.5 times the risk. If the price action breaks above the fair value gap, the trade will automatically be cancelled. Here's another example for a short trade. We see the market formed a bearish fair value gap, the price action pulled back into it, and then the candlestick crossed and closed below it. The rules to buy are exactly opposite. First, a bullish fair value gap must be formed in a market. Second, the price action must break above it and form a pullback. And third, a buy order should be placed as soon as the market closes above the fair value gap after the pullback. It's recommended to set the stop loss slightly below the fair value gap. By the way, if you want to learn the full strategy with this indicator, check out the ICT Fair Value Gap video. I'm gonna leave a link to it in the description below. On the first place, we've got a new and highly accurate indicator by LuxAlgo called Smart Money Concepts. This indicator includes many features relevant to SMC, such as full internal and swing market structure labeling in real time, break of structure, which is labeled as BOS, change of character, which is labeled as CHOCH, order blocks, those can be bearish and bullish, equal highs and lows, fair value gap detection, previous highs and lows, and the discount zones. Okay, now let me briefly explain how this indicator works. Whenever the price action crosses and closes above the most recent level of resistance, a change of character occurs. This change of structure can be considered as a signal to enter a long position, but I personally like to enter the trades when there is a break of structure. This happens when the price action breaks above the most recent swing high after the change of character. Okay, let me show you one more example. As we can see, the price action is currently in a downtrend. This is confirmed by the most recent change of character label, which is bearish. A few candlesticks later, the price action moved to the upside, and we had a bullish change of character. And we had a second confirmation to enter a long position, which is a bullish break of structure. Exactly opposite is true for short trades. Notice here the indicator spotted a bearish change of character. And then we had a break of structure where the price action crossed and closed below the most recent level of support. And the reason we don't take trades at a change of character is because these are very early entries. We want to be taking trade continuations only, which are the break of structure signals. I backtested this indicator myself with some other tools and it gave me a win ratio of over 70%. So definitely give this indicator a try, and if you have any ideas on how to increase its win rate even more, please let us know in the comments. Actually, I do know a trick that will instantly increase the win rate for any indicator, and that is to add a good volume indicator that would eliminate the majority of losing trades. And if you want to know what volume indicators are really worth your time, make sure you check out this video right here.